Shares in Comair rose nearly 3% as the South African operator of British Airways and Kulula.com returned to a first half profit. Now that's helped by cost cuts, better ticket prices and new fuel saving plans. Comair's half-year diluted headline earnings per share totaling 16.4 cents. Well, let's unpack the numbers with CEO Erik. Erik, it's good to have you with us. Thanks so much for joining us. And of course, looking at that bottom line number, of course, a sigh of relief, I'm sure, to finally show shareholders that the initiatives that you have been talking about, innovations, are starting to bear fruit. Let's talk about some of them. Revenue was up 20%. You talk about a fuel surcharge that's been added to British Airways tickets. Talk to us about that and how reactive you have to be right now to changing oil prices.
Well, the fuel surcharge has been there since 2004. It's just a mechanism to price the tickets more rapidly to adjust for the fuel price effect. We've also seen, in terms of the systems we implemented in Kulula, we had a huge capex project last year to implement an enterprise-wide system to manage Kulula's inventory more effectively and the pricing more effectively. And that also results in pricing much more responsibly to demand on flights. So if we see a very high demand flight and we see the passenger numbers picking up very rapidly, it will automatically adjust the pricing more rapidly than what was done in the past. So it's just closing those gaps and tightening up all the processes.
Being much more responsive to demand, basically.
To demand, and on the BA side, much more responsive to the fuel price movements.
Mm-hmm. When it comes to the oil price now, I mean, it looks like it's heading back towards $120 a barrel. I'm sure quite a scary thought at a time where the company is just showing profits.
Well, we're not that concerned anymore. I think the expectation in the past, especially from a lot of investment analysts that we spoke to, was that airlines could only survive in an environment of initially $40 a barrel, and then it moved to sort of $60 a barrel, and most recently there's sort of been talk about, well, you can only survive in $80 a barrel. But with the changes we've made in the organization now, particularly in the fleet upgrade, also in the systems upgrade, we are actually positioned to quite comfortably deal with $110 a barrel these days.
Mm-hmm.
So
but it's 120, and it
well,
looks like
120 is fine.
Yeah.
We'll deal with that too. I don't think, in terms of the adaptability to the fuel price, that's really been the crux of the investment project. Has been how do you live with a fluctuating oil price with this kind of magnitude of fluctuation? Mm-hmm. So it's not necessarily the quantum of the oil price, it's the flexibility to deal with these oil price movements. That's the critical part.
And the mechanisms are in place now. An interesting innovation there, some might say, for the airline industry. What about price inflation? I mean, what was your ticket inflation last year?
The actual price per ticket, in terms of the extent to which we raised the airfares themselves, was only around 9%. Considering the relatively huge increase in the fuel price, etc. Now the balance of the increase in revenue just came from this more effective pricing and the more responsive pricing, and in that we saw around another 11% improvement in revenue. So industry-wide increase in pricing only came in at about 9%. And I think that's why we have seen pressure in other airlines that haven't adjusted structurally to this volatile oil price.
Mm-hmm. So overall in the South African markets, I mean, you talk about passenger sales and that falling on a year-on-year basis, a shrinkage in that. Is that an indication of consumers just, even if the demand is there and you up the prices, there's a level at which they just can't afford to fly?
Definitely. There's quite extreme price elasticity in the aviation market, and we have typically seen that total revenue growth in the domestic market is about 2 times GDP. Anything else beyond that typically results in, if the fares increase beyond that, typically you see the volumes declining proportionately. So it is a very sensitive market to pricing. That was part of the reason why we had such a struggle in the first half of the previous financial year, was that the oil price had risen very rapidly and we couldn't simply put the airfares up at that rate of change because the market just goes into shock. So one has to manage the pricing according to the market's expectations. Every ticket is effectively being sold in auction. Yeah. You're putting it out there and the consumer is saying, yes, we'll buy it or we won't buy it.
Mm-hmm. What are your plans when it comes to routes this year, and where are you seeing particularly demand emerging for new routes?
I think the most prominent opportunity at the moment that we're looking at is Mozambique. We'll be starting to fly to Maputo again from the beginning of May. We did fly
Kulula or BA?
with British Airways. We did fly to Maputo a while ago with the Kulula brand from Lanseria, but that was really a holding position until we could get rights from Oliver Tambo Airport, because a lot of the traffic into Maputo is connecting traffic from international airlines. So now that we've got those rights, I think Maputo is going to be a good route for us. And the other route that we're adding from the beginning of March is to East London twice a day.
Let's talk about some of the developments in the sector. I mean, one time we know that it's up for sale, up for rescue, I suppose one might say. Fastjet has indicated that they would like to be a buyer of it, and you've indicated that that would be unfair, given it would go against government's regulation when it comes to international shareholding. What's your stance on that right now?
Well, we're not concerned necessarily about the buying out of one time or the resuscitation of one time. I mean, that just improves competition in the domestic market. So that's not the issue. The real issue that we see is that in terms of getting rights into routes, or rights on routes into Africa, they're all governed by bilateral negotiations between governments. And that's the reason why there's this 25% foreign shareholding restriction on domestic airlines. Because what's ultimately going to happen here, potentially, if Fastjet gets the rights to own 100% of a domestic airline, is they effectively get the right to the route from both ends of the route, whereas us as a domestic carrier would only get the right from South Africa. So effectively what we end up doing is giving a foreign carrier an opportunity that South African carriers themselves can't take advantage of.